Good morning and welcome to the fourth week of Illinois Soybean Association's Agribusiness Management Summer Webinar Series. I'm Emily Carls, Field Staff for Illinois Farm Business Farm Management and one of the AMP advisors for ISA. AMP, a new program from ISA, is an educational resource for farmers and ag professionals to hear the latest agribusiness advice and receive guidance on their business needs. This summer, we are offering the AMP webinar series as a free 5-week program where experts will present on agribusiness topics, including succession planning, grain marketing, and more. Today, we have 2 presentations for you. First, Brooke Starks and Kent Leesman will participate in a panel discussion on succession planning called Planning Strategies for the Farmer's Toolbox. And later this morning at 10 a.m., Jonah Kolb will present a webinar titled Look Beyond Cash Rent, Growing Your Leased Acres with Farm Managers and Investors. But before we get started, we wanted to review a few housekeeping items to help make the best of this virtual experience. You can ask questions of the presenters or ISA webinar staff utilizing the GoToWebinar dashboard on the right side of your screen. If you are having audio or technical issues, please alert the staff through the dashboard as well. I'd also like to take this time to thank today's session sponsor, Compeer Financial. Compeer's support of this program, along with our other partners and sponsors, is invaluable to its success. Now, without further delay, I'd like to introduce our first speakers of the day, Brooke Starks and Kent Leesman. Brooke Starks is a shareholder attorney with the law firm of Meyer Capel in Champaign, Illinois, where she focuses her expertise on wills and trusts, wealth preservation, and farm and business succession. Planted firmly in the fertile Midwest, she especially enjoys counseling her clients in the ag sector. Brooke earned her BA from Monmouth College and her JD from the University of Illinois. Kent is part of the Illinois FBFM field staff and grew up on a family farm near Hartsburg, Illinois. He serves over 130 full-time farm accounts in Southeast Logan County and serves on the Illinois FBFM leadership team as an area manager. He is a graduate of the University of Illinois Urbana-Champaign with a bachelor's degree in crop science and agricultural business. Brooke and Kent, you can take it from here.
All right, good morning, everybody. Thanks for joining us. I'm going to share my screen and get us started. I hope. Okay, here we go. So Kent and I have put together some slides to kind of talk about a couple of tools for the farmer's toolbox. And we think these apply pretty broadly. These are not all the tools by any means, but these, we put our minds together and came up with a fact scenario that represents a large portion of the number of clients and customers that we serve and the issues that come up for them. And so we want to walk through that and hope that that will be representative of the scenario that a lot of you may be facing in different stages of your succession from one generation to the other of your farm operation. So to get us started, we have just a little fact pattern that I'm going to read through. So Mr. and Mrs. Every Farmer own 600 acres of prime Illinois farmland. Mr. Every Farmer farms an additional 2,500 acres on varying types of leases. They have 2 kids, Andy and Becky. Andy's a successful accountant and lives with his family in Houston, Texas. He has no plans to return to the farm, but he appreciates the history. And Houston is expensive, and he has 3 kids to put through college. Becky works for a local grain marketing company and lives with her family 15 minutes from her parents. She is heavily involved in the farm operation at planting and harvest and helps as needed in between seasons. Mr. Every Farmer is 65 and would like to retire from farming within the next 5 years. He would like to switch farm roles with Becky, essentially, and have her assume the operation, including the farming of the Every Farmer's own 600 acres, while he continues to help during planting and harvest. Mr. Every Farmer owns $1.5 million of equipment. Mr. Every Farmer's tenants know Becky, they're familiar with her, and they're willing to sign new leases with her or with a new farm entity as the tenant. So that sets us up for our discussion. And as Kent and I talked about how best to bring this forward to all of you, we wanted to focus on two of the most common questions that we get from our clients and customers, and really walk through how those two questions can be put into tools that help with transition planning. So one of the most common questions is, well, what do I do with all this equipment? What's the best way to get my equipment over to the next generation? And it's a big question because many of our farmers are carrying upwards of $1 million to $2 million of equipment. So there are essentially four options that we see, four main ways for equipment transfer. And I'll walk through these, and then we'll dive into each of these a little bit more in depth, and I'll let Kent jump in here. So there's the piece by piece transfer, which is essentially each year, every farmer sells a particular piece of equipment to Becky. So in a good year, Becky might buy more equipment or more expensive pieces of equipment. In less fruitful years, she buys less equipment or a less expensive piece of equipment. So there's just as the years go by, Becky starts to buy pieces off one at a time from her dad. There's an installment sale option where Dad and Becky enter into a contract for the purchase of all of Dad's machinery. So he says, I've got $1.5 million of machinery, and you're going to buy it all, Becky, and every year you're going to pay me X dollars a year for so many years. So in this scenario, maybe it's $150,000 a year for 10 years, but it can be whatever works for the two parties to complete the purchase of the machinery from Dad. There is a lease with option to purchase. So Dad leases his equipment to Becky for X number of years. The lease amount has got to be fair market value for the equipment. Fair market value can be determined in a couple of different ways. At the end of a series of years, Becky then has the option to purchase the equipment. And in this case, we use the number 300,000 because the safe harbor rules say it's got to be at least 20% of the value of the equipment. So 20% of 1.5 million was $300,000. So at the end of the lease term, Becky can have the option to purchase for 20% of the fair market value. And then there's the operating entity transfer. And so when we say operating entity, most of the time we're referring to an LLC. Some people have limited partnerships and things like that out there. The most common new structure is an LLC. So when we say entity, we're mostly referring to LLCs. And in this scenario, Dad creates or uses an existing entity to contribute leases and equipment for transfer to Becky with operating agreements and buyout agreements in place. So in other words, the entity owns the equipment, and over time, it transfers shares of that entity to Becky, or Becky buys those shares over a period of time. And we're going to dive into each of these a little bit further. So Kent, I'll turn it over to you to kind of walk through some of the pros and cons.
Sure. Thanks, Brooke. As you can see in those outlines, one of the biggest investments that most of my farmers as a accountant that I deal with in the biggest decision of transferring, sometimes it's the leases and sometimes it's, you know, some nuances and landlords and things, but a lion's share of the wealth in the intermediate term of the balance sheet is in machinery. So this is by no means a small decision as it relates to how to transfer these types of assets. The decision to move these assets consists of a couple different scenarios, but you gotta always keep in mind there's two parties involved in most of these scenarios. There's a buyer and a seller. Well, they both have different goals. A lot of the seller's goals are get my full fair market value and income tax. Those are huge decisions as it relates to how fast this thing's going to be gone. As an accountant, that's a big deal to me. And if I'm usually representing both sides, we try and find the happy balance in both of those. So as we go through these four examples in detail of some of the pros and cons, just know where you fall in the audience here as to where you fall onto each side of these. Some of you could be thinking of retirement, transferring out. You might take some pieces of this puzzle and decide what might be best. Some of these transactions are within family. Some of these transactions are arm's length transactions amongst people that aren't related. All those considerations are different as to which one of these go as you think about these pros and cons for each four of these categories. So those are some of the things I wanted to describe as we go down these next four slides. So piece by piece purchase of equipment. Yeah, it's pretty simple. I mean, we're really not creating a lot of formality. We have a bucket of machinery from the willing seller. So let's just call this seller, Mr. Everyday Farmer. Let's assume Becky is the buyer as a family member, but insert Becky's name with the neighbor's son, down the road that you have no kids. You can insert that person in this too. So it's inexpensive. A piece-by-piece purchase of equipment can be drafted on a Word document signed by the willing parties with an amount and a canceled check, and you're no different than a machinery dealer at that point, right? So you're basically taking this piece of equipment and listing it for sale, coming up with an agreed-to price. It's flexible. There's nobody obligated to any piece of this equipment. We get down the road, and one of these guys, decides that this isn't necessarily something that they have to have, or the willing seller says, hey, I can fetch a little more money by going to this consignment auction down the road with this thing, because there's a lot of people buying this style of planter, and my buyer doesn't necessarily need it. You've got the options to go amongst different routes, or you can list it on Tractor House. Basically that's some of the options we got as the pros and cons. It's arm's length, informal, probably don't need an attorney involved in this particular scenario. I got a lot of these running with family members. These are just, let's see what the tax plan shakes out. I do the tax plan for dad. I look at the son at the same table and I say, son, it's time to pony up 50 grand, and that's going to represent these two pieces. They come up with an exchange transfer document, and the check's written. It goes into the taxable income for one. The only difference is if you go to the cons, the son is a related party, might not be subject to 179 expense election issues, but usually sons or children who have a lot of beginning expenses might not need the 179 election as a related party. So that's a downside, right, on the right side in the third one. There's no formal documentation. If you go back to the top of that line, uncertainty in death or divorce, there's no formal agreement in place. If dad passes away unexpectedly in a year, whatever was decided really isn't documented. So basically it becomes a part of his estate, and his estate could be dealt with by an executor that might not be interested, another brother or sibling if there's no wife involved or the spouse involved, and then the wife could be dealing with this particular scenario with a son, and maybe she wasn't in all the discussions. So there could be some conflict there if we don't have a lot of these things documented. Well, in this particular agreement, those documentation items are pretty poor as far as it relates to a long-term plan, but usually this works on a smaller scale fair market value. If we're talking about less than $300,000 or $400,000 fair market value, maybe it isn't as big a deal. So, and in which case the buyer might not be able to afford some of these things if the income changes. We're working in financial times here at corn and soybean prices and yields where they're at, expenses where they're at. We might kick the can a couple years on some of these larger pieces, and dad might be okay with deferring that income too. So, and then one of the other problems is, we're getting use usually of this machinery as a son or daughter coming into the farm operation. There might be some reimbursements needed to be made for insurance and maintenance on this particular piece of machinery, because clearly the seller, whether it be dad or the neighbor, isn't really interested in maintaining the machinery as it's being used on the farm. So there could be a rental agreement as a side deal here to make sure that we're covering all of our costs as well. Secondly, an installment sale. What we wanted to describe here, an installment sale, coming from an accountant's point of view, and then if Brooke wants to add in a little bit as to what her ideas are on the attorney's side, this is a fairly documented transaction. It shows all of the lists of machinery and the fair market values, whatever attached supplemental appraisals you wanted to. It's binding, easy to administer, spreads the amounts over several years. The term's usually between 5 and 7, could be 10, could be 3, but generally speaking, it's in that middle level of term. Usually it consists of pretty good sizable amount of full line of machinery, which could range from 500,000 to $1.5 million in this scenario. Let's just put this one to bed right away. The cons: as the seller, the IRS views an installment sale. Now consider this all taxable income to the seller, right? All taxable on day one is this particular type of transaction. 99.999% of the sellers would say this is a deal breaker. This is not what they want. If I was the accountant in the room, I'm putting my hands up in the air and I'm saying, time out. This isn't what we want to do. We're not willing to pay on $700,000 machinery, because usually we're trickling out grain inventory at the same time. Not a good idea. So it's a pretty basic conversation, but it usually gets skimmed over pretty quickly. And the buyer's performance, if you look at this, the installment sales, same term, 5, 6, 7, 8 years, whatever, but the performance sometimes doesn't match the payment plan. So let's just assume that son's having some hard times and dad wants to forgive a flexibility or add years to the term. There could be something in documentation that says that, but generally speaking, there's not. So if for some reason there's a cash flow crunch, we're going to get more financing then to cover some of these payments, and those things don't match. The taxable income and liability doesn't match this scenario. So not usually the preferred method.
And so just as a reminder, because we broke away from the screen where we had them all detailed, the installment sale is the situation where you enter into an agreement for the sale of all of the equipment, but you decide that those payments are going to come to the seller over a period of years. So we've got $1.5 million of equipment in our scenario that we laid out at the beginning, and we're saying over 10 years, because that's easy math for me, we're going to pay $150,000 a year. What Kent is pointing out is that all of that $1.5 million of income is considered to be recognized, assuming that the equipment's all fully depreciated, is going to be recognized in that very first year. And we want to be sure to drive that home, because this question comes up quite a bit. I have clients come and ask about this particular solution on a fairly frequent basis. And so we want to kind of put that one up there just for the sake of being able to knock it down, because as Kent pointed out, most of our clients, almost no one wants to recognize all the income tax liability at once. So we mostly put this slide up for purposes of illustrating why this is not typically a good option. What we like instead, and maybe the most common, is the lease with option to purchase equipment. Ken?
Sure. This is where it gets a little more sophisticated. These are a pretty good option for. It's a pretty good option when you have a situation to where you're going into a binding agreement. The amounts are set. The lease installments are considered as it relates to cash flow and other methods. That's a big part of the buyer's interest, is making sure there's no crunch. No seller wants to put the buyers at some sort of a disadvantage financially, however they want to accomplish the goal. So the IRS views this as an installment sale, but the IRS does not view this as an installment sale. However, it looks a lot like one. But the documentation, as we get help from somebody like Brooke, the documentation then helps this become a viable option as we get around the installment sale method. So basically it's a double declining purchase from a list of machinery on full value. We look at this piece of paper on the right showing what each lease payment might represent. However, the IRS will only see the lease payment amounts as it relates to the total dollars as it declines. And some of those dollars are fixed. Some of those dollars end up going down as the years go on, depending on how it was amortized. Like I said, well documented. So if somebody passes away, there's an issue, there's no question about where we're at in the process. There is no Social Security tax. That's a big deal. of Social Security tax farmers get to pay by being on a Schedule F. That comes through as rental income or lease income, or it's not capital gain, it'd be recaptured ordinary depreciation, however your accountant wants to do it. All those answers are the same as it relates to income. But usually the maintenance and agreement is documented in this document. So the buyer's willing to pay for all the repair bills and the insurance as it relates to this particular line of machinery during the leasehold interest. And then if the buyer defaults, we might have a bankruptcy situation or some sort of situation. The seller actually never got bought out of it. They just got rental payments. So that could be taken back and then been theirs. Kind of like a contract for deed, if you've looked at that on real estate. Very similar ideas that the buyer defaults, the seller still has the title, it's an escrow. Usually the attorney has a copy of all this, and usually you're using the same attorney, both the buyer and seller in this particular transaction. You don't want multiple attorneys giving their opinions about how to handle this, because one of the cons is there's a lot of documentation. It has to be right. So Brooke is going to earn her weight in gold by producing what, Brooke, 20 pages worth of documentation on here, including appraisals. So, and then the IRS is going to,
you know.
Yeah, right. The IRS is going to, if it in an audit, they're going to get a smell test on this thing too. So all these documents need to be shown in an audit. So that's my insurance policy too. I tell them, you know, if we're as an accountant going to go through these hoops and make sure it's all well documented, we don't want this thing not to pass an audit smell test when it comes through to be looked at. And usually, if there's all the things are being done like it's supposed to, usually has no consequence. So.
That's right. So to recap on this one, what it looks like is, let's say it's Dad and Becky in our scenario, enter into an agreement where Becky is going to lease the equipment from Dad, fair market value on the lease. So there are a couple of different resources for determining what would a third party lease this kind of equipment from at an arm's length transaction from another person. It needs to be at fair market value, but Becky leases for a number of years. And then at the end of that lease period, Becky has the option, and it has to be an option, it can't be a requirement, but Becky has the option to purchase for roughly 20% or at least 20% of the equipment's original fair market value. It's at that point in time, isn't that correct, Kent?
Correct, yeah, at the end of the term, and then the title's then assumed. The other thing that goes into this a little bit that's a little weird is the lending, right? So the lenders like to view these documents as equity payments, so it gets a little funny on balance sheets just to determine, okay, are these payments for 50 grand a year in Becky's scenario, is that listed on her machinery list as a capital lease? Do we show those payments as actual purchases as it relates to equity? And then on the buyout, if it is truly optional, usually what happens at the end of this buyout, the 20% is in the advantage of the buyer to go ahead and purchase, right? So we're not gonna, the chances of not buying this thing out are very low. We're not gonna, unless there's a complete derailment, the buyer does, or the seller does not want these assets back. In fact, a lot of these assets in the documentation could be traded 3 or 4 times already, right? So this is just a piece of paper that shows what's going on. So those assets might not even exist anymore because the buyer's got full has some documentation that shows that they can go ahead and buy, sell, trade, and exchange some of these things. So the buyout is usually a slam dunk for the seller, and it's usually at an advantage to where the buyer would never not buy that out, right? Because there's usually a higher fair market value at stake than what the buyout would be. So,
agree. All right, so that's lease with option to purchase. Our fourth option that you saw on a few slides ago was to use an entity for transfer of equipment, but we're going to get into a discussion of entities more holistically, both land owning and operating entities. And so we will fold how transfer of equipment may work in the context of an operating entity into this next discussion here. So let's just go over what an LLC is and how it comes to be formed and how that works as a tool for farm succession in general. So in our scenario, let's say Mr. and Mrs. Every Farmer form an LLC. So an LLC is a business entity, all right? It makes sense to us. I usually tell clients, it makes sense to you that the local plumbing company can own a storefront. So we know that it can own real estate. It can own a fleet of vehicles. It can own accounts at the bank. It can own all kinds of things. An LLC is just a business entity, and it can own almost anything that an individual can own. So Mr. and Mrs. Every Farmer form their LLC, and in our scenario, they each own 50%. They could decide for various reasons that one owns 51% and one owns 49%, or that they own 75 and 25. They can decide, because they're spouses, how to allocate those percentages between them. So once they form that business entity, then they deed their 600 acres to the LLC. So they own their 600 acres outright with no debt against it. And an attorney prepares a deed for them, and they say, Mr. and Mrs., as individuals and as husband and wife, hereby deed our 600 acres to the Every Farmer LLC. And so now the LLC is the landowner, not the Every Farmers. And as Kent and I were talking through this presentation, we both agreed that that is a point that is difficult for some of our clients and customers to wrap their heads around. Some of them get hung up at that, on that point in particular, but there you are exchanging your dirt for shares of a company, and essentially, and the company now owns the dirt and you own the company. The LLC, that's why that's in bold and underlined, is now a land-owning business entity. All right. Then the rules for how this company or this entity are going to run are contained in a document called an operating agreement. It is possible to create an LLC without having an operating agreement. And if an LLC is owned 100% by one person, which we call a single member LLC, or even in cases where it's owned by two spouses, it's not all that uncommon to find LLCs where no one ever created an operating agreement. So an operating agreement isn't a base requirement for making an LLC exist. But if you have any intention of using that LLC to bring other members of the family in over time or even at death, an operating agreement is an essential tool that lays out all of the rules and restrictions for how the entity will run. It's highlighted there, you'll see, and there is a whole lot of flexibility in how you create that operating agreement, in what rules and restrictions you put into it. Over time, once the Every Farmers have created this LLC, they can gift away interests in the LLC to Becky and or Andy. They can also, the kids can also purchase interest in the LLC over time, and the Every Farmers can make gifts of those LLC interests at death. So we can make lifetime gifts and gifts in a will or a trust at death. Lifetime gifting amounts are exclusion amounts. So this is the amount that you can give without the need to report it to the IRS. And it doesn't use any of your exemption. Right now is at $15,000 per person. So between Mr. and Mrs., they have $30,000 of value that they can give to each kid. While $30,000 seems like a drop in the bucket, contrasted against millions of dollars of value, if they start it early enough in time and make a practice of doing it year after year after year, they actually can transfer out quite a substantial amount of value. And there are some additional ways to capture some discounts to that value that go beyond our presentation today, but we can take interest in the LLC and under the right circumstances, value them at a little less than just 50% of what the value of that 600 acres was. We can take a little bit of a discount on that value, sometimes a fairly substantial discount on that value depending on our circumstances, and we actually can push more value out using those gifting interests over time. So this is just something to kind of put in your toolbox, as we say, to have a discussion with your advisor, your accountant, your attorney, as brainstorming ways that you can start to pass wealth and pass the landholding interest down from generation to generation. And as we'll discuss here in a little bit, we can also use it for the operation itself insofar as transferring the equipment.
Yeah, I was going to add in there, Brooke, if you got a minute, I was going to add on that that particular slide there. You just got to keep in mind that Brooke had mentioned that this is very, very strange because most people view that 76 acres they bought in 1980 as a very special asset they had, and they held it and things, and no longer are those assets held as individual units anymore, right? So the yield, they all matter inside this operating entity, but usually that entity is a 50-50 landlord to Becky at this point. And sometimes we add, let's say Becky, normally there's a kid out there that has a land ownership already, right? So Becky might actually in this particular example put in her 40 or 80 acres as well. And that might cause a little grief by her, but she still gets to use that as collateral on her balance sheet as a percentage, but it's no longer the 40. It's 2 or 3% of the 680 in this particular situation instead of that, which also increases the discounting as we relate to estate tax purposes and things of that nature. But she's also bound to the same operating agreement in this. So this could be a wealth generation tool that includes a lot more scope than just mom and dad. This also I see used as a vehicle to transfer children's wealth as a one family unit vehicle to go down a road with as the land holding wealth creating entity as it relates to how this operating agreement is drafted. So and as an accountant, it's our job to keep it all straight on the tax return as far as it relates to basis and profit loss percentages and capital accounts, which is a whole nother conversation for a different time.
Good points. So the inner workings of the LLC, we've touched on a couple of these already. It is a business entity. It's registered with the state. One of the questions that I receive is, well, what are the requirements on an ongoing basis to keep it running as a business entity? And there's an annual registration. But other than that, it's fairly simple. It can, as far as what the registration requirements. It can own most of the types of assets that you own, like we discussed. The shares of the company are called membership interests or percentage interests. They're not really called shares, but people seem to have a better conceptualization of shares of stock. Shares of stock are for a corporation. For an LLC, they're membership interests, and we generally refer to them in percentages rather than number of shares. The record of the membership percentage interests are kept on the books of the company. So instead of certificating, although it is possible to certificate with an LLC, for the most of the time that's not the case. So we keep a record of the books of the interest owned by each of the parties, and when one party wants to transfer some percentage interest from themselves to another party, that's just a documentation. It's a piece of paper in the books of the company that says, I, Brooke Starks, hereby transfer 5% to Kent Leesman as of January 29, 2020. I do know what year it is. So it's right on the books of the company. The governing corporate document is called the operating agreement, as we were discussing. Operating agreement can contain specific provisions limiting a member's right to transfer membership interest. This is a big attractive piece to many of our farm families. So things that can be included for interest would be limitations on who is eligible to own these membership interests. We only want to limit that ownership to members of our immediate family or to descendants of a certain lineage. We can contain restrictions on the right to partition a piece of land. There's a misconception out there that people must own better than 50% of a tract of land in order to force a sale of that land. That's untrue. They only need to own some percentage, a percent, less than a percent, 0.5%, to force a partition of the land, which then results in a sale of the land. We can require members to give that up or surrender their right to partition when they enter into the LLC. We can provide for death, divorce, all kinds of things in that operating agreement. The LLC can be member managed, which means every member is a manager of the company, or it can be manager managed. We pick one person to be in charge. Frequently, that's the case where we've got an on-farm heir and one or more off-farm heirs. From time to time, well, more often than not, I would say the on-farm heir is selected as the manager, and there are pros and cons to that we can discuss. And a person's membership interest in an LLC is personal property, not real estate. I added that bullet point because for estate planning purposes, you should know that Illinois assesses estate tax on estates exceeding $4 million per person. I have many clients who have taken Illinois farmland and put it into an LLC, and then those clients move and make another state their residence, and they no longer own Illinois dirt, subject to Illinois estate tax. They own stock or membership interests in an LLC, and your stock, your personal property, is deemed to reside where you reside. So for instance, if they move to Florida, their LLC interests live in Florida with them, and as of right now, Illinois does not extend its reach to grab onto those. Kent, do you have anything on that slide?
No, that's going to be a little bit more of a popular discussion is Illinois in their fiscal state that we have. It's probably going to be a little bit more of a commonality because it doesn't take much Illinois farm ground to be over 4 million. Now, we could get around a lot of that with discounting, but there's only so many options we got as it relates. And when you get above $5-6 million worth of real estate in one person's estate, the discount options as it relates to just your typical discounts just start getting hard to go to the levels we need to be at 3.99999, right? So my thought is this might become more of a popular option as people would rather do anything than is to give Illinois some estate tax as it relates at the side of their death. Now, just preserve that wealth for the next generation and hope for the best.
Yes. All right, do you want to take the lead on this one?
Sure. Considerations for a land owning LLC. We talked a little bit about the party surrender the right petition. I guess where we're going to go with this slide here, I just wanted to inform you that we're going to talk about an operating LLC here in the next slide. So we talked about some of these things, but this is just a little bit more considerations as it relates to the land holding entity in our example versus an operating entity, which Becky would probably end up creating separate from the land holding LLC. So we usually in the operating agreement want to discuss some of these questions, right? This is just something for you to think about when you go down that list of discussion. I would never use an attorney. If you go to an attorney, and this is just, my recommendation for anybody that's looking to do something more, I call this sophisticated, right? This is a sophisticated option. Never go to an attorney, your local attorney, and you look at them and you ask them, here's what I want to do on a presentation that I heard today on the AMP webinar. And if they look at you like you have 5 eyes and they've never done one before, chances are that might not be the attorney for you. So we don't want anybody to cut their teeth on some of these things. We want to be able to use a professional, and I would always recommend that as an accountant. Always use a professional who has created some of these things and see some of them play out. Has a canned document that they can use to share with you to go through. It has a lot of examples and questions. And this just isn't for Brooke, but anybody that I work with. Sometimes we go past our local attorney at this level, okay? So always keep that in mind. There's no harm in having a local attorney help with local things, closings and land transactions, things like that. But when we're getting to sophistication here, we must use a professional that has done several of these and sees these play out in certain family situations, because it does require quite a bit more sophistication, and these questions all have to be answered. So I'll let you all just read through that. As you get copies of this slideshow down the road, you're gonna refer back to some of these things and see exactly what it is we're talking about. But we talked a little bit about the estate discounting there at the last bullet, and how those discounts can be given on an undivided interest discount, and then on top of the undivided interest discount, in the operating agreement, they can only select from a few people to be able to transact these sales. Well, then there's a membership discount associated with this estate plan as well. So as we talk about the Illinois problem, we got a normal discount of 15% for an undivided interest. Oh, by the way, you can only sell to 4 people. Oh, by the way, they have to take a certain discount themselves to keep from selling. They can sell to members within the party or lineal descendants, but they cannot sell at full value. Maybe in the operating agreement, they can only take 60% value as it relates to the assignment of interest on an appraisal. Well, all of a sudden, we got all kinds of discounting we can take as it relates to an estate plan within this particular land holding LLC. This would be the most common, besides having it all kind of clean and the personal property things and all clean in one organization. All the deeds are in one. It is nice to have those. A lot of these guys have, and gals have, this land holding LLC. The vast majority of them need the discounting. So.
Great points. And we don't, I just want to point out, we don't want to see generally land and equipment in the same LLC. We're trying to silo our risk, and generally our equipment is the riskiest piece, right? It's traveling up and down roads, it's trucking into congested areas. That's our biggest point of liability exposure. We don't want that bundled up together with the land that provides our source of income. So we don't want to see land and equipment, generally speaking, in the same LLC. So as we shift, we've got considerations for an operating LLC. And this is an LLC that is designed to generally hold the equipment and be the operating entity for the farm operation.
And in this particular, and I'll let you all read through that, but the key here is land as it relates to heirs and assets and wealth is in bucket A. Bucket B is going to be Becky creating a farm operating LLC. Now, this LLC could have been created and contributed. Most of them, we throw the leases in this thing. We've got Dad in as a non-profit loss, but he did contribute his machinery, so he's got a little bit of a capital stake. But inside there, it holds one of the options for buying machinery as well. So we've got maybe a piece-by-piece sale. Would be not an example here. The installment would not be an example here. It would be basically this lease to buy option would be held in this LLC as we pay Dad off over a period of time, or Mom, or whoever owns the machinery, and we run that thing down the list, and we've got this operating LLC to hold that, and it creates, and it's one entity now that either Becky and her husband or whoever ends up being the operator, or maybe Becky has got a kid that has come back that is interested in farming, and maybe we've got them in this thing as well. But it does keep the assets separate, and it keeps the liabilities separate, and that's a big deal when you have an estate that's got a little wealth in it. We don't want to have those risks out there. It's insured separately. The employees are in this thing. It might even have another corporation or another LLC come through this that holds the trucking company. Maybe there's a sizable side business that is being run that we don't want to have muddled in with the farm. Well, we might have that separate of books, and it runs through this, and we get an even secondary level of protection in LLC with a higher risk business. Anyway, there's a lot of flexibility in these LLCs, and I don't want to get overcomplicated here, but retirement planning transition holds all the machinery. You go down to the bottom. I like the fact that it consolidates all the analysis, the accrual income statements, the balance sheets, and that's where I come in as an accountant. There's nothing better than having 5 farmers, and we would like to analyze them. Usually it's a father-son working together, or we've got a dad or so retirement, and we're trying to get our head around the overall picture as it relates to expenses. Well, some of those expenses are muddled between different people, and this consolidates all that. So when we're simplifying the business and the accounting, we can actually see a lot more of what our costs per acre are, as we have one operating entity that's going to end up growing, hopefully, to farm the ground in the future. So a lot of good things here coming from this operating LLC that I like as it relates to Becky's option. And she's probably in her, 50s, and has a kid maybe in high school or college that's interested in coming back. This would be a great vehicle to do that.
That's right. And I think an important takeaway, just to help folks wrap their heads around the LLC concept, is just like we talked about with a land owning LLC. Let's say dad contributes all of his equipment to this LLC to begin with. And over time, Becky purchases. So now what dad owns, the LLC owns the machinery, dad owns shares of the LLC or membership interests of the LLC. And over time, Becky purchases shares of the LLC from dad or from mom and dad. Or maybe it's a combination. Mom and dad gift some shares of the LLC each year, but Becky also purchases some shares of the LLC each year. And over time, dad's share of the pie gets to be smaller, while Becky's share of the pie gets to be larger. And so, and yet all of the consolidation that Kent was talking about is there on the books, and the transition of the shares, dad's shares going down while Becky's shares going up, is all happening just right on the books of the company. So right there on your own set of books.
And it's usually nice to not have, when we're talking about family and descendants and heirs, it's nice to not, include Andy in this one, right? So Andy has nothing to do with the farm operation, the machinery. It's a complete separate transaction with mom and dad, with Becky in this scenario. Makes sense that Andy wouldn't have any interest in this. So that cleans that up as well, in case there's an unforeseen death or some sort of circumstance that Andy now is in a present situation where he's concerned about what's going on here. So I'm looking at the time, Brooke. Let's see if we can get to the last one here in this, and we can have time for some questions. So land and operating LLCs and opportunities. I like to start them as an accountant on 1/1. So I've got a few appointments scheduled here in August to get our heads around when to start these LLCs. And it's easy to transfer prepays and inventory and things like that as it relates to an LLC. Have to be calendar year. 1/1 is a great time to do that because it ends in accounting for the individual, starts in accounting for the new company, ends up running all the financials, then seamlessly go into the next entity as we go forward. So we put in all those percentages and make sure everything's clean going into it. I like the 1/1 start of whatever fiscal year. And we talked about some of these other benefits to both.
I think we've hit most of the others on this slide.
Yep, I agree.
So I'm going to go forward because we wanted to talk for just a minute about the human factors and limiting beliefs, or what we call personal hurdles to moving succession forward. So we believe Mr. and Mrs. Every Farmer, all of our clients, have to consider our successor's ability to afford the opportunity. We've got $1.5 million of equipment. Does Becky need all of that equipment? Does she need the latest and greatest combine, or is it better to sell that off separately and Becky enters into this at a lesser model? The successor's ability to manage the opportunity and finance it. So again, positioning our successors, the next generation, to be able to afford to buy into this and to take it over. The unwillingness to change, right? It's worked. If it ain't broke, don't fix it. We have to realize that farming is changing. It's going to look different for Becky at the end of her career than it looked for dad at the end of his. It's constantly evolving. And if we want to set them up for success, the next generation, we've got to be willing to embrace some degree of change and step back from it a little bit. Multiple generational goals are different. We've got Gen X's, millennials, and now we have Gen Z's, I think it is. They all are different. It's not that they're bad, it's that the way that they work and the way they prioritize, the way they manage money are all shaped by different life experiences, different economic events that have happened across their lifetimes. It's different. It doesn't mean it's necessarily bad. Personalities may not match what the retiree wants. We hear that a lot from our retiring farmers. Don't like the way that Becky's doing it. Don't agree with it. But we've got to come to some agreement on whether, if dad wants out, how are we going to get you out? Spouses' goals, family goals, and considerations. So not just Mr. and Mrs. Every Farmer, and not just Becky and Andy, but their spouses are part of that discussion. Whether you want to bring them to the table and bring them to the meetings is a different question, but Becky and Andy are certainly talking to their spouses about these big decisions for the family as well. On-farm versus, I'm skipping down to on-farm versus off-farm heirs, because that's one of the most prevalent questions that we get. One of the reasons we both like LLCs, especially the landholding LLC, is it's a way to bring Andy, in our scenario, in as a passive interest holder. So he gets to own a share of the family farm that is inside the LLC. That means he gets income stream every year from the rent. But he is not necessarily in a position to pull the rug out from under Becky. And that's one of the main reasons we like that framework. And another part of the conversation as you talk with your advisors is how to equalize to Andy. And we've all heard that phrase, fair is not equal, right? And that's very true. But what do those discussions look like? There are some creative ways to make that palatable to everyone using LLCs. Ken?
Yeah, I would just summarize this before we start taking some questions. I guess I just want to go scroll down here. Y'all can read some of those bullet points there. My big takeaway from something like this, as I look at my group of farmers and my little spot in Central Illinois, which I'm fairly biased, I think it's probably one of the best spots in the world to raise a family and farm in Logan County, Illinois. But I will say, the consistency I see in the group of farmers I work with as I analyze their business on a day-to-day basis, they're not all doing all these sophisticated things, but they are doing one thing, and that one thing in common is they are in the top 20% of operational efficiency and productivity, and they manage their operations at a little bit higher level, the sophistication generally, than the bottom 80%. My prediction today is that top 20% will farm 90% of that opportunity in the next 10 to 15 years. We've got a ton of retirements that are scheduled here at some point in the next 5 to 15 years. The average age is 60, 62. It seems like it's been there forever, but these farms will transition, and they will go to people that have a vehicle and they are in place to accept this responsibility on a basis to encourage success. And I wanted to just point that out as I see it as an accountant and an analyst. I think that's a big set aside for these farm families as they go forward. We want Becky to be successful. We want Becky's children to be successful. These provide opportunities and ways to do that. So with that, Brooke, unless you have something else to say, communication is also a big deal in my families as well. So make sure we always communicate just like we are today in this particular webinar. And let's open it up to questions. I don't know if Emily's going to jump back in here for us, but answer just a few questions.
I was going to say, while Emily jumps in, I would offer this from the estate planning attorney's perspective. Most of the conflicts that I see in families are from lack of communication. Most of the conflicts that we see are when someone had an expectation that something was going to go a certain way and then it didn't. So even if they don't like what mom and dad decided, ultimately, if it's communicated clearly, this is what we're deciding and this is why, most of the time, family members will accept that. But it's when they thought mom and dad were going to do X, and then they find out after one of them dies that it's really Y, that's when the chaos ensues. And so tagging on to that communication piece, I can't emphasize it enough. So Emily, do we have any questions?
Yes, thank you, Brooke and Kent, for that great discussion on succession planning and resources for farmers. We do have a few questions from the audience today. The first one, and I think you touched on this a little briefly, what are the pros and cons of selecting on-farm heir as manager versus member managed in an LLC?
I can start that and then Brooke fill in. We ain't got much time left, so we'll try and get a couple extra questions in, but the pros and cons are there's a conflict of interest, right? That's the biggest obvious elephant in the room. When the heir or present is farming both sides of this and managing the decisions. They're also in this operating agreement, from what I've seen, is their documentation is we're going to try and have as much wealth retained inside this land holding partnership as possible. And if the goal is to grow that from 600 acres to 1,200 acres, the distributions might be a little bit in question as we retain those earnings and then we keep that money inside this LLC, but yet we kick out taxable income. Those are problems, right? That you want to create conflict with the off-farm heirs. You hoard every dollar that's earned and give them a tax bill. Brooke?
Yep. And contrasted with, and this is going to leave everybody thinking, well, then what do I choose? But contrasted with making things member managed and getting too many cooks in the kitchen, so to speak. So we've got too many votes and it gets complicated to even make some of the simplest decisions. So maybe a solution is a co-manager situation. Where you have one that's on farm, one that's off farm. Of course, they have to have a workable relationship for that to make sense.
And the operating agreement creates these rules too, tiebreakers and other things that if there's a standstill, and they can also describe in the operating agreement that yes, a minimum distribution has to be 50% higher than the taxable income on an annual basis or something like that. And then there, a lot of those frameworks are set. Most people would be okay with something reasonable. So.
Perfect, thank you. And the next question is, if you are currently operating on a cash accounting basis, how is that handled when transferring into an LLC in January of a given year?
So that's a very specific question. Cash accounting, if you're the farmer and you're creating a farm holding LLC, contributed capital would make up for a majority of that. At the basis level you have, grain, zero basis, all taxable. Move that, make those grain sales in January into the new entity. Machinery, no titles usually, just move that into the new entity, right? So whatever the depreciation schedule shows goes in. And then from there, we decide what the tax consequences are, and we try and manage those appropriately. Prepays would then go in as well. So those are some of the things as a cash basis accounting. And then as far as the land holding entity, usually dad exhausts all of his inventory personally and just the deeds go in, and as a crop share landlord, those things just flow into that particular entity for the following year.
Perfect, and we have just about 1 minute left here for our last question. Do you have any guidance on the different types of LLCs and when it is best to use each type?
Well, I was going to say, there are, when we're saying types, I assume that we're saying land holding versus operating, because LLCs themselves are just one type. I don't know that there's specific guidance on when is the right time, but if you have liability concerns for equipment, that's a reason to create an operating LLC. If you want to talk transition, that is a reason to create a land holding LLC. You really just have to sit down with your advisors, your trusted advisors, and say, is this right for me? And then be willing to do the book work and the follow through that creating an LLC requires.
Perfect, thank you. That's all the time we have for questions now. Thank you to our sponsor for this session, Compeer Financial, and thank you to our AMP partners, Illinois Farm Business Farm Management, the University of Illinois Farm Doc, and the Illinois Soybean Association Checkoff Program. The recording of this presentation will be posted to the ISA webinar archives on YouTube and sent to all attendees via email this week. We are now going to take a short break and reset for our 10 a.m. session with Jonah Kolb, so stay tuned.